So government debt has expanded massively over the decades. Since 1971, government debt, this is the USA, has increased from $389 billion to around $37 trillion today. That's nearly 100 times as much. And if you look at this chart, on the chart here, you can see the government debt, which is the green area chart at the bottom with a yellow line at the top. And you can see the government debt's been increasing fairly constantly year after year, sometimes a little bit faster, sometimes a bit slower, and it's starting to increase a little bit faster, and it's likely to accelerate away from here due to the fact that the interest burden is becoming more and more important. Because back in 1971, which is here on the chart, in 1971, the debt to GDP ratio was only 25%. In other words, the total debt of the United States was 25% of their GDP. It was quite manageable. Today, we're at around roughly 100% debt to GDP ratio. It's 4 times as much. In other words, compared to the economy, it's 4 times larger than it was in 1971. And the debt is as big as the entire economy itself. And the Congressional Budget Office predicts that debt to GDP ratio is going to continue to rise. And obviously it can't rise ad infinitum, because sooner or later something will go wrong. It always has in every country in the world where debt has become too burdensome. And on this chart, I'll just adjust it slightly there. On this chart, you can see the green area is the government debt, and the red line is the gold price. Both of these are on a logarithmic scale. So on the left-hand side, we've got the log scale for government debt, and on the right-hand side, we've got the gold price in dollars, also a log scale. And I've drawn a blue line, a straight line here, which roughly matches the past growth in government debt. If it were to continue at the same pace, and I stress that a lot of people think it will accelerate at a faster pace, me included, but if it continues at the same pace, we will see, in all probability, gold keeping pace with the rise in government debt. So what would that mean? It would mean by 2027, we might be looking at a gold price of 5,900. That's a best guess at it. It's not a prediction as such. By 2030, we might be looking at 7,800. By 2040, we might be looking at 18,900. And by 2050, $50,000. Now, I don't seriously think we're going to get to these high numbers, because I think the currency something's going to happen to the currency before then. Whether it's replaced by a new currency or there's a complete failure or a spiral out of control, I don't know. But my feeling is something's going to go wrong before we get to 2050 and see $50,000 gold price. But anything is possible. So keep be prepared for the unexpected too. Let's just have a look at the increase in government debt compared with money supply. Now, this is a bit of a more recent chart. It goes from 2004 to, where are we today? It goes from 2004 to 2025. That's it. It goes up to July, in fact. And here you can see the red line is the M2 money supply of the G20 countries. The scale is on the left-hand side, is a logarithmic scale. At the bottom, it's 15 trillion. I should have put the figure in there. And 15 trillion. I think it's trillions. And on the right-hand side, you can see the gold price, which again, I'll just shrink that a little bit. To show you here. Yeah, on the right-hand side, you see the gold price rising from roughly $400 to around $4,000 over the period. So the gold price is keeping pace with the expansion of money supply, it's keeping pace with the expansion of government debt, and those trends, which are almost looking like they're straight line or accelerating, they're not likely to go down, and probably the gold price will continue to keep pace with the rise in debt and money supply. That's what they've tended to do in the past, what gold's tended to do in the past, and probably what it's going to do in the future. So one of the big problems with US government debt is the interest on that debt. Because the level of debt has risen as a percent of GDP, so has the interest burden as a percentage of GDP, and we're in a higher interest rate environment than we've been in for the last 15 or 20 years. So currently, the interest being charged or having to be paid on national debt is increasing at quite a fast rate. So in 2021, the interest on the US national debt amounted to $352 billion. That's the figure from the Congressional Budget Office. To $352 billion in 21. 3 years later, in 2024, it was more than double at $881 billion. So it's gone from 352 to 881 billion in 3 years. And the interest burden is going to keep rising according to the Congressional Budget Office, their own numbers. It could be worse than they expect. Congressional Budget Office is forecasting that the US government debt owned by the public will reach 120% of GDP within a decade, and it might go faster than that. When debt burdens rise, history suggests several possible outcomes: higher inflation, restructuring, or some form of capital control. All of these scenarios, if they occur, have historically been supportive of gold.
When you look across the long arc of monetary history, one thing becomes uncomfortably clear. No fiat currency has ever survived its own success. They all begin with noble intentions: stability, coordination, national cohesion. And they all end in the exact same place: a mountain of debt, a political class that cannot reverse course, and a collapse in confidence that comes suddenly, then all at once. And if you look carefully at the numbers, the charts, the trajectory of the US dollar today, you will see that we are not heading towards something new. We are accelerating towards something very old, something that has happened dozens of times across centuries. The modern observer calls it a debt crisis. The historian calls it what it always is: the end of a currency regime. And so, when people ask me why gold is rising, why silver is behaving like a coiled spring, why central banks, governments, and sovereign wealth funds are accumulating metal at rates not seen in modern history, I tell them the truth that most economists refuse to utter. The monetary system is transitioning, not collapsing. Transitioning from one era to the next. And during every such transition, gold does not merely perform well, it becomes the anchor around which the entire new system is constructed. Let us begin with the basics, because the numbers alone tell the entire story. In 1971, when President Nixon severed the last link between the dollar and gold, the US government owed approximately $389 billion. Today, just over half a century later, that figure is $370 trillion. That is not a growth rate. It is an explosion, a metastasis. The debt has multiplied nearly 100-fold, while the underlying economy has struggled merely to double or triple. No currency in human history has survived such a divergence, because mathematics is merciless. It reminds me of an old line by the economist Herb Stein: if something cannot go on forever, it will stop. And we are living through the moment when the mathematics of debt has begun to make its presence felt. Look at the debt to GDP ratio. In 1971, it was 25%, manageable, even conservative. Today it is 100%, equal to the entire economy. The Congressional Budget Office, hardly a crowd of gold bugs, predicts the ratio will reach 120% within a decade, but many analysts believe this is optimistic. Historically, once a nation crosses 100% debt to GDP, the slope steepens sharply. Empires don't glide gently, they accelerate. They push harder on the very tools that broke the system, because politically, there is no going back. And the most revealing part of this is interest expense. In 2021, the US government paid $352 billion in interest. Just 3 years later, that number has surged to $881 billion. That is not an increase. That is a warning siren. It is what every collapsing currency regime looks like in its final phase. Debt compounding faster than revenues, interest compounding faster than growth, and policymakers unable to reverse course. When interest consumes the government's budget faster than healthcare, faster than defense, faster than any discretionary spending, it ceases to be a line item. It becomes destiny. And destiny, in monetary terms, usually leads to one place: inflation, and then debasement, and then replacement. This isn't speculation, it's mathematics again. But mathematics is not the only storyteller here. History is. And if you study the last 700 years of monetary transitions, from medieval debentures to the collapse of the Spanish real, to Britain's pound sterling losing reserve status, to the turmoil of the 1970s after the gold window closed, you find an extraordinary consistency. Gold rises not because investors become greedy, but because the system becomes confused. It rises when trust declines. It rises when governments no longer allow honest price discovery. It rises because it must. One of the most revealing charts of the last 2 decades is the comparison between government debt and the price of gold. When you plot them side by side, both on a logarithmic scale, you see that they move almost in perfect synchrony. It isn't that gold reacts to debt, it's that gold reveals it. It is the only financial asset that cannot be printed in response to political pressure. And so, when people say, gold is in a bubble, I ask them, relative to what? A currency being created at 15% per year. That is not a bubble. That is mathematics. Here is where the story becomes even more compelling. In every prior monetary transition, gold eventually becomes not merely a hedge, but the core of the new system. Look at 1933. Look at 1944. Look at 1971. Every time the currency regime buckles, the world returns to the one asset that is no one's liability. And despite the narrative sold by Western economists for the last 50 years, that gold is a barbarous relic, the behavior of central banks tells a different story. From 2010 onward, central banks have been accumulating gold at the fastest pace since the 1960s. China, Russia, Turkey, India, Kazakhstan, Uzbekistan, even Poland and Hungary, countries with very different ideologies and geopolitical alliances, have all reached the same conclusion. The dollar's best days are behind it. Not because America failed, but because no reserve currency has ever survived this long at the top. Empires rotate, hegemons rotate, monetary power rotates. And when one system weakens, the next one quietly begins accumulating gold to prepare for the handover. Even the Bank for International Settlements, the central bank of central banks, quietly reclassified gold as a Tier 1 asset in 2019, equivalent to cash or US Treasuries. The mainstream media barely mentioned it, but to those of us who study monetary history, it was the clearest signal yet that the world was preparing for a new chapter. But the gold story is only half of it. The real drama is unfolding in silver, because silver is the market where true price discovery arrives first. And what we are witnessing today is unprecedented. Liquidity evaporating, derivatives failing, open interest destroying itself, and a genuine, visible shortage emerging across multiple continents at the same time. This is not narrative. This is happening in real time.